Yeah, very good afternoon. Myself, Dr. Ravi Kumar. We are going to now discussing about financial marketing services as a part of this Black Four financial services too. Under this, we have merchant services, mutual funds, credit rating, and venture capital. These are the major concepts in these four financial services. Now we are going to discussing about merchant discounting. Today we are going to discussing about merchant services and also mutual funds. What is merchant services? So let's see what is the merchant services meaning, and that is overview of the merchant services. The merchant services refers to the broad category of financial services designed to help a business accept and process payments from the customers. So the merchant services is providing the broader category of financial services, not limited to particular thing, but it's a broader category of financial services. It's providing and designing and helping to business concepts and process payments from the customers. So these services integral to modern commerce, enabling transactions through various payment methods such as credit cards, debit cards, electronic payments, and mobile wallets. So nowadays, every customer or that candidate is going to using maybe some people are going to using credit cards, some people are going to using debit cards, and some people are going to paying through electronic payments like Phone Pay, Google Pay, and some other payment gateways, and even also mobile wallets. Like all mobile banking services are going to providing the mobile wallets to the customers. So now this merchant services is going to providing all these services. Now merchant services are provided by financial institutions which are by banks and specialized payment processing companies. So merchant services, it's a broader category. In this, we are going to using such a broader category types of payments. Now, all the financial institutions and banks, especially, they're promoting these banks now, payment gateways and also specialized payment processing companies. So all the companies are going to nowadays, nobody is going to taking is very reduced the taking of DDs, taking of checks. It's a very minor part. But nowadays, people are going to sending money instantly by adding their mobile number or else scanning by particular account number, or else with even even using that other card also they're paying that money to the customers. So with the mobile number, with Aadhaar card, with the scanner code, with the account number, IFSC. So anything that can be easily accessible to do the transactions with one to another person, or person to the financial institutions, or person to the specialized payment companies, or also and bill payment gateways like insurance, gas, and recharges, or whatever things, what are the regular payments are going to be there in the market. The people are going to using these merchant services. So this transaction is known as merchant services. Here the merchant and the vendor and also the customers. So the people are going to using these mobile wallets or electronic payments or the payment gateways. Now, what are the key components of merchant services? The payment key components here. Merchant services has a key components, that is a payment processing and a merchant account. So payment processing, what is the payment processing? It facilitates the acceptance of various payment methods, including credit, debit cards, and electronic transfers. So including authorization, clearing, and settlement process also. So nowadays, banks are authorizing the transactions, whether that amount is limited, it's more than 2 lakhs, 3 lakhs, or something. They have to authorize in the banks. Even in the UPI payments also, there is a limited, there is a limit to send the money from UPI services. Maybe up to 1 lakh rupees. So it's beyond that also is going to be there. That the bank is also getting that authorization, getting the confirmation from the customers. So clearing of checks and settlement process also is there in the payment processing. So here the credit card, debit cards, electronic transfers also part of payment processing. And merchant accounting. Merchant, a type of business account, business bank account that enables merchants to accept payments electronically. So they are going to providing all merchant now bank accounts. They're simply by adding their numbers. They're sending through NEFT or RTGS or else instant payment IMPS, and acts as an intermediary between the merchant's business and the customer's bank. So the customer's bank is different, merchant bank is different, because different types of accounts are there. So in the business segment. And what are the key features of merchant banking? So here the merchant banks has some key features that are advisory services, capital market activities. Here, advisory services nothing but mergers and acquisitions and advisory. So this merchant bank is going to providing the advisory services to the people, those who are going to there in these mergers and acquisition transactions, and corporate restructuring and financial planning. Corporate restructuring, how that companies are going to restructuring their financial planning. So for that, this is a merchant bank is a advisory services that providing advisories to their clients and assisting in the rising capital and debt management. The company sometimes they used to fall in the debt, and how to raise the funds from the public or from the investors or from the other financial institutions, and how they are going, they how to manage the debts. So these things are going to be given by the merchant banking and capital market activities. So underwriting of equity and debt securities. In these features, capital markets providing underwriting of equities, how to purchase, how to sell the equity, how to sell the debt securities. All these things are going to be underwriting by the merchant banking, that is going to providing that service is going to providing to the their clients, and managing initial public offerings, IPOs, initial public offerings, and follow public offerings. So initial public offering, but the company is going to starting in the new, they're accepting the primary source of funds from the public, and FPOs also is a follow of the public offerings. Those who are going to investing in the already market, and they have to they are going to diversify their funds in one place to another merchant services, and facilitating providing private placements of securities. So these merchant banking also providing the facilitating the private merchants of securities. And the project financing. And sometimes the companies are going to coming with good projects, but they don't have sufficient funds. So here the merchant banks is going to providing the project financing, that assisting the companies in identifying viable project. So sometimes they used to bring beyond their budget. That's the reason that companies used to this merchant bank is going to providing assisting how to identify the viable project, and arranging long-term and short-term funding for projects. So if the companies are not suitable for long-term, they are going to referring to short-term. If the companies want to have a big aims or visions, these companies are going to providing the long-term funding projects. And the portfolio management. Here that merchant banking is going to providing them managing the investments for corporate and individual clients to optimize returns. So here the thing is that that investors money should be diversified to different portfolios. By that they are going to earning money, and if the company, one company is going to giving losses and some other company will give profits. So if the person has a 1 lakh rupees, they are going to diversifying into different companies, maybe 5 companies, 4 companies. So that is a portfolio management. Then only the customers or clients get optimize their returns, and risk management, advising on managing financial risks, including currency and interest rates, interest risk. So current year, the risk management also, how that risk is going to be associated with the particular investments. So these merchant banks are providing that what are the associated risk is going to be there when they are going to investing money. So advising on managing financial risks, including currency and interest rates risks, and also corporate counseling. It offering a strategic advice on diversification and expansion, and also joint ventures. So the corporate level, that merchant banks is going to offering strategies how to mitigate, how to collaborate, how to be a take a part of the company. So this kind of joint ventures, this kind of expansion of the business from one place to another place, and the existing business in the existing business, how to invest money, how to promote, how to expand from one place to another place, maybe in the domestic level or in the Indian level, or domestic, sorry, international level. How they are going to expand in their business, and diversifying of the funds are that investments or their services into the market. So this is also one of the corporate counseling is a part of the merchant banking. Another part is that functions of merchant banking. Here, the functions, merchant banking is one of the major functions is that raising the funds for the clients. How to raise their funds for clients. So merchant banks assist in raising funds from capital markets and institutional investors by structuring financial instruments tailored to client needs. So raising, how to raise the funds to their clients. And that means in the merchant banks assisting in raising that, for example, the funds, how much is required to particular company or organization in the capital market. And facilitating mergers and acquisitions. Yes, that we discussed that the merchant banks is going to providing or facilitating the. So these are also one of the function of the merchant banking. Underwriting. Yes, what that we discussed about the equities and the debt securities. Under that underwriting, how to underwrite that this merchant banks guarantees the subscription of securities issued by the companies, thus providing a safety net to their issuers. So in that case of equities and debt securities, and loan syndication. So they help arranging syndicated loans from multiple banks for large scale projects. So syndication, sometimes the banks are going to syndicating whether that person or the person's profile or the company profile is not eligible, then all the bankers cannot issue the loans. But here the merchant banks are providing that kind of solutions. And foreign investment advisors like FDIs, in case of accepting the investment from the other source, other countries, these merchant banks guide foreign investors on regulatory framework and market entry and investment opportunities. So this foreign investment policy also part of the merchant bank's functions. And what is the importance of the merchant banking? So all these things we are going to we have discussed about the functions, features, and some other strategies. So here the importance of the merchant banking, the capital market development. Merchant banks play a significant role in developing the capital market by mobilizing savings and channeling them into productive investments. And the capital market it is one of the important aspect of the merchant banking. So capital market development, how to develop the capital market. So these merchant banks play a significant role in developing their capital market and economic growth by supporting entrepreneurship, industrial growth, and corporate development. Merchant banks contribute to the overall economic development and development of a nation. So in the nation, how that companies are going to be there and economically, and for the economic growth of the nation. So nation and specialized enterprises. So their deep understanding of financial markets and corporate finance helps business navigate complex financial decisions. The complex, if there is a lot of unsolved issues or that critical issues, these are the specialized enterprise that is going to be provided by the merchant banks. These are even these also these merchant banks also understands about the understands and giving the expertise things and the risk mitigation. Merchant banks assist in identifying and mitigating financial risks, ensuring smoother operations for business. So, risk, how the risk is going to be mitigated and involved in this particular um, service things. So, that is one part of important part of the merchant banks. So, merchant banks assist in identifying and mitigating financial risk, ensuring smoother operations for business. And the challenges in the merchant. What are the challenges of merchant banking? So far, we have gone through the merchant banking, but challenge is one part of the merchant bank. So regulatory compliance. So adhering to multiple regulatory requirements across jurisdictions can be challenging. So merchant banks, in for example, if you're good taking merchant solution in Hyderabad, so that may not applicable in Bangalore or Chennai or some other Delhi. So this kind of othering multiple regulatory requirements across the jurisdictions can be challenges. So when you're going to transaction with the merchant banking, so we have to consider that challenges and the market volatility. So fluctuations in financial markets impact the performance and profitability of merchant banking. So merchant banks, merchant bank volatility that fluctuates the financial markets impacting the performance and profitability and competition. So the government is a growing presence of merchant banks and fintech firms intensifies the competition in this sector. So there is a competition in the challenging of the merchant banking. So the growing presence of the investment banks, how the banks are the financial technology, financial technological companies or tech organizations, how that firms are interfaces the competition in this sector. And high risk merchant banks are going to providing the looking and focusing on the financial instruments and transactions in kind of high risk categories. And example of merchant banking services. So what are the examples of merchant banking services? So merchant banks also providing merchant bank services in India. For example, Kotak Mahindra Capital Company and ICICI Securities. These are the two Indian companies are providing merchant banking services in India. So if you are going to looking for any merchant banking services, we may consult that two organizations in India. One of the major security companies are capital merchant banking services provided by these capital Kotak Mahindra Bank and ICICI Kotak ICICI Securities. So when you look at global, Goldman Sachs and City Merchant Bank Group, these are the global level. So Goldman Sachs is completely in the ES only. That's giving the merchant banking services in the ES, one of the because why we have to discuss about this use means, so one of the leading or else leading country in the globe in terms of merchant banking or in terms of net worth and also economical conditions also. And the City Merchant Banking Group also is providing the in the global level. So that is going to be providing the states to state, country to country, the global, they are going to providing the merchant banking services. And merchant banks play a pivotal role in bridging the gap between the large business and the financial market and also supporting the strategic decisions and growth. So merchant banks it plays a vital role, that means important role in the pivotal role in bridging the gap between a large business and the financial market. So it's supporting the strategic decisions and growth. Now, another concept of the today class is that mutual fund. What is the mutual fund? What are the importance? What is the use? What is the significance? Or else what are the benefits? What are the challenges are there in the mutual funds? So, as an investor, you used to diversify funds into different portfolios. So mutual fund also one of the part of the investment platform. So let's see the overview of the mutual funds. A mutual fund is a financial instrument that pools money from multiple investors to invest in a diversified portfolio of securities such as stocks, bonds, money market instruments, or other assets. So mutual funds, that means those who are going to are running by these mutual fund transactions. These mutual funds, diversification of the portfolios of the securities such as stocks, bonds, money market instruments, and other assets. So these banks are going to providing this kind of, mutual funds are going to having the stocks, bonds, money market instruments, and that was managed by the professional fund managers. Mutual funds provide an opportunity for small and large investors to access professionally managed portfolios and benefit from economies of scale. So the mutual fund way, the people are going to taking that is an opportunity to raise their funds in an economic scale. That means the people want to get more or be stabilized in the market in terms of economical conditions. See what are the key features of the mutual funds. So here the pooling of resources. The mutual funds, one of the mutual funds key feature is that pooling of resources. Investors collectively contribute funds, creating a large pool that can be invested across various assets. So in the market, in the stocks or bonds or securities market, the people, they don't know how to invest, where to invest. So this mutual fund institutions is going to providing or pooling the fund, pooling of the resources. That means capital into the companies. The professional management. There is experienced and fund managers who handle the investments, making informed decisions based on research and market analysis. So they then generally, if the mutual funds companies are going to working on research on the investment portfolio. So there is a wide range of experienced persons or managers, fund managers handle the investments, making informed decisions based on research and market analysis. So the people, those who are going to there, that they are going to this is look about the key features of the professional management is the key feature of the mutual funds. Mm. And another feature is that diversification. So what does it means, the diversification? So yeah, the diversification of the different types of assets, asset classes. So high range, middle range, and low range. They are going dividing into their different part categories. So this mutual fund invest in a mix of asset classes, reducing risk through diversification of the funds. So how they want to diversify the funds into different portfolios. And liquidity. Most mutual funds offer high liquidity, allowing investors to buy or redeem units on, that is the demand, expect for closed-ended funds. So that there is a liquid, but that means instantly if you are going to converting into cash, if you are going to investing money in a stocks or bonds, you may redeem immediately. So on demand, how much you want, how much, for example, you invest 1 lakh rupees, how much you want? Maybe about 80,000, 90,000, 70,000, or total 1 lakh rupees. So that depends upon the investor's demand. You may withdraw your or redeem your funds. For example, if you are going to earn about, for example, invested 1 lakh rupees, you are good earning about to 50,000 rupees on your investment. So you may put or keep your amount that 50,000 rupees in the same place. And what are the returns are there? You may demand, you may withdraw, you may redeem, or else you may also purchase some other investment of shares, or else you can also invest depending on that. So you may purchase the bonds or securities in this mutual funds category. And affordability. Investors can start with small amounts, so making mutual funds accessible to a whole audience. So affordability is there. So as a uh, mutual fund, they are going to ask, looking about the investments, how to invest in a small amount in the mutual funds. So there is accessibility to wide audience. That means a number of people they can purchase, they can invest. So that is the reason this is affordability features. And regulated environment. Mutual funds are regulated by financial authorities. Example, SEBI in India, SEC in the US. So Securities Exchange Board of India, Securities Exchange Commission in the US. So ensuring transparency and investors protection. Here, the SEBI or SEC, they are going to protecting or also giving the protection or safety to their funds, because these are the regulated bodies. That is a mutual funds. One of the features is that is the regulated environment, and authorities are going to be there. They are going to handling and controlling, monitoring about the mutual funds. And what are the types of mutual funds? Let's see, is that based upon structure, there are three types of mutual funds. That is the open-ended funds. That means allow investors to buy or redeem units at any time. So at any time, you may open-ended funds are there. It allowing investors to buy or redeem at any time. And closed-ended funds also is there. Have a fixed maturity period, and units can only be traded on the stock exchange. So either closed means the what are the closed maturity. That, for example, have a fixed maturity is going to be there for a particular time period, maybe 5 years or 10 years or say 10 years, 15 years. So up to that, you are going to investing money. So and units can only be traded on the stock exchange. For example, how many units are there? You're going to investing 10, you are purchasing 10 units that you are going to putting for 10 years. So every day or every month, they are going to investing money. That is the closed-ended funds and also interval funds. It operates as a hybrid, allowing transactions at a specific interest. That means these investments may be useful. We can use in a open-ended cases or closed-ended cases in a two-way. That is a hybrid model. So in a hybrid model, that funds are going to be utilized or allowing the transaction at a specific interval period. And another thing is that based on investment objective. Here, we have seen about, we come across that structure of the mutual based upon the structure. Now here the based on investment objective. So as an investor, what do you want to, how to raise, how to invest, where to invest, that must has other person. So here that here the mutual funds also giving the equity of the funds. Here invest primarily in stocks for high returns with higher risks. So how to raise these funds in a different how to and get the how high returns from through stocks. That is the equity fund is the one of the best options. But there is a higher risk is going to be involved in the investment. So as an investor, he must understand about the objective of the equity funds and debt funds. That means the focus on fixed income securities like bonds offering lower risk and steady returns. So the debt funds is nothing but we are going to purchase the bonds. For example, government institutions or corporate companies. These are, for example, these are going to be providing the debt instruments, that is bonds. So offering low risk and steady returns. So there is because government is going to certifying and they are going to paying interest and return in time. And hybrid funds. It is a combined equity and debt investments to balance the risk and the reward. So these are one of the objectives. So sometimes the people used to think about hybrid funds. So that means you want sometimes you want for long, you want to invest money for long term, and sometimes you used to invest money for short-term purposes only. So only purchases up to purchase particular sales time, they are going to be there. So this is one kind of the hybrid funds and the money market funds. So invest in uh, stock return, highly liquid instruments for lower risk and um, yeah, risk mobile fund. So we can see that money market funds, how that companies are going to be there in we invest in short term high liquid instruments for the low risk. And other thing is that specialized mutual funds. Here the specialized mutual fund nothing but sectoral funds, index funds, international funds, and thematic funds. Sectoral funds nothing but invest in specific sectors like IT, healthcare, or energy. So your mutual funds should be invested in IT sector or healthcare or energy sector. So as that companies, they must diversify their funds towards IT, healthcare, and energy segments. Index funds. So mimic mimic the performance of a popular stock market index, example, Nifty 50 companies and Standard Poor 500 companies list. So index funds are going to be there India and across the globe. So depends upon that about 50 national companies. So they are going to invest in. Along with that, the companies across the globe, about 500 companies are there. In the probes are some some other um, agencies. So they are going to providing these services and international funds. So international funds invest in global markets, not in the Hyderabad. If I go to sitting alone in Hyderabad, you're going to invest money in Hyderabad. That is not in a that doesn't give a uh, proper returns. And also thematic funds. It focus on the themes like ESG. So ESG and environmental and the social governance. So they have to consider the social um, focus on the like say, environmental, social government. And what are the advantages of the mutual funds? So let's see the mutual funds. What are the advantages? Here, diversification. So diversification is also one of the advantage of the mutual funds because you're not going to investing in one particular IT sector, ITR, some other sectors. So you are going to reducing your reduces the impact of poor performance of a single security on the overall portfolio. So you are reducing by diversifying. So reducing a risk by diversification of the mutual funds. So that's the reason. So there is one kind of the advantage and a professional expertise. It was managed by the skilled professionals who have access to market insights and data. So the professional by skilled professionals. That is one of the main things that organization completely must managed by the skilled professionals who have access to market insights and data. So and cost effective. So expenses ratios are shared among all investors, making the cost lower. The managing an individual portion. So individual portion, I think, but they are going to diversify the funds. and the flexibility, transparency, accessibility. So flexibility, one of the flexibility is also known as one of the advantage of the uh, advantage of the um, so flexible. Investors can choose funds based on their financial goals, risk tolerance and time horizon. So how much risk is going to be there? Whether that person is going to be tolerable or intolerable. If the tolerable, that high risk, if you're going to facing that risk, then there is a chance to get more returns also in the high risk category. And if you can also reach your financial goals, and also time horizon, how much time is required to withdraw or else to get the returns from the particular company. So there is a flexibility is also one of the important point of the mutual funds and transparency. Here, regular updates, disclosures, and audited reports ensure transparency in operations. So, here the complete up-to-date data will be provided to the investors or the traders. So, there is a regular updates is going to be there, and disclosures also is going to be. That means the disclosure nothing but revealing their performance, company's performance, and audited reports ensures companies uh, transparency in a companies and accessibility. Systematic investment plan, SIPs, allow investors to invest small amounts periodically. The SIP is nothing but systematic investment plans. Every month, you may invest money, allow investors invest money in a, allow investors to invest small amounts periodically. Though you can also choose investment um, systematic investments is one of the riskless investment plan to the investors. And what are the challenges of mutual funds? Whether we have any challenges are there in the mutual funds? Yes, certainly there is a challenge are going to be there in the mutual funds. Market risk is there. How that markets are going to be facing and uh, providing that and having that market risk. So returns are not guaranteed as they depend on the market performance. Let's see what are the challenges of that. Market risk is going to be there, expense ratio is there, liquidity constants, overall over diversification, tax implication. Let's see what is the market risk. So risks returns are not guaranteed as they depend on market performance. So market is completely fluctuable, so that cannot be stable. So that there is a market is going to be always fluctuating. So nobody is going to giving any guarantee. So sometimes the shares all of a sudden maybe increase or maybe fall down. So we have to take the risks in this segment. So returns are not guaranteed as they depend on market performance. Sometimes a gold market, for example, all of a sudden market is going to be fluctuates. Stock market always changing. The commodity market, secondary market, primary market, everything everywhere. Market is not constant. And expense ratio, high maintenance fees can be reduced overall returns. For example, we are going to reduce withdrawing, there is a high management fees is going to charge because they are going to managing your funds in different portfolios. So if you are going to investing that money at the time of maturity, if you are going to invest withdraw, then they must be paid that management fees and liquidity constraints. some funds like ELSS, that is the liquidity linked savings schemes. So equity linked savings schemes have lock-in periods. So sometimes if you are going to investing for 5 years, that is going to be locked. That is equity linked savings also is going to be there in that scheme. So we have to lock our amount and over diversification. So excessive diversification may dilute the returns. Yes, certainly. Sometimes we are going to overcoming that risks. At the same time, we may not get exact funds even returns also because you are going to diversifying in multiple sources of multiple times. So if you are going to diversifying your funds, nothing but you are diluting your returns. That is the point of the diversification and tax implication. So capital gains from the different source, so subject to the taxation, which can be affect net returns also. So definitely, if you are going to earning money from through mutual funds, it is completely commercial and financial, not in a some other part. So if you are going to taking money from this segment, earning money, so certainly we have to pay the tax. Um, we have to pay the tax to the governments. Importance of mutual funds. Here, the wealth creation as one of the important of the mutual funds. So mutual funds create the wealth creation. They help individuals to achieve long-term financial goals such as retirement, education, and home ownership. So importance, this is the one of the important of the mutual funds category and the simplified investments. They eliminate the need for investors to track individual stocks or bonds. So simplifying that investments, so that is one of kind of the important part of the mutual funds category. And economic growth, by mobilizing household savings into productive investments, mutual funds contribute to the overall growth of the economy. So if you are going to investing money, nothing but that is economic growth because you are going to pay income taxes or tax on profit, GST, all things are going to be part of the economic growth. So by mobilizing household savings into productive investments, mutual funds contribute to the overall growth of the company. Key considerations before investing. As an investor, we have to consider what are the key considerations. What kind of things should be considered before investing a money in the mutual funds. So here the investment goals. What is your investment goal? How much you want earn per month, per annum, per year? Like that, everything it should be in a goal. So assess your risk tolerance. How much you are going to assess your, how much you are going to tolerate your risks and financial goals. What are your financial goals? How much you want to earn money from these mutual funds and how much, what is the time horizon? How much time is going to be there? It is a short term, long term or middle term? How much time is going to be there? So as investor, you must consider, see about the investment horizon to choose the right type of mutual fund. So here we have to consider the risk tolerance, financial goals, and investment horizon. These are three concepts are important in the investment goals. As investors, we should consider this point always. And expense ratio. Review the expense ratio, which includes management fees and other costs associated with running the fund. Lower ratios generally result in higher return for investors. So expenses, how much we are going to spending money on returns, how much that is the, we have to look about the review, we have to see the review, we have to consider that we have to assess, we have to evaluate the reviews of the expense ratio, which includes the management fees, how much they are charging from the customers. If you're going to investing 1 lakh rupees, how much they're charging. If they're going to investing, if they're going to withdrawing how 1 lakh rupees, how much they are charging, whether the investment process, either and some other withdrawing time, how much they are going to charging that fees and other costs associated with running the fund. And parallelly, if you are going to balancing your money with some other parts and diversification type, how much they are also charging and what are the associated cost. And lower ratios generally results in higher returns for investors. So low ratios generally results in higher returns for investors. So that's the reason we have to consider that how much expense is going to be there in the mutual funds. And risk profile. So we can see companies sometimes, all of a sudden fluctuates their rate of profits. The company's performance must be considered whether gradually their earning or their growth, or else drastically there is any change to be there. So understand the level of risk associated with the mutual fund, as different funds have different risk levels based on the assets they hold. For example, how much they are going to holding, how much risk is going to be there. The company whether going to giving profits or not, they are going to giving a good profits or not, performance or not, and a fast performance, how the companies was performed in earlier. So while past performance also is not an indicator of the future results, it can give insight into the funds management and how it navigates market fluctuations. So we consider as a part of these things. So in this market segment, we have to see, look about the past performance, how that companies are going to performing the these things. So while performance of this is not an indicator, but also we can see what are the how that companies are going to navigating the market fluctuations. And let's see the examples of mutual funds, mutual fund companies in the world or India. So in India, we can see HDFC Mutual Fund and SBI Mutual Fund. So these are the important mutual fund segments. So when you are going to looking about mutual fund segment, we can always look about the HDFC Mutual Funds and SBI Mutual Funds. They are the important things. When you see about the global level, Vanguard Group, iShares, that is a BlackRock, and Fidelity Investments. So these are the three global level mutual fund companies. So Vanguard Group's BlackRock iShares Global and Fidelity Investments. So all these are the important in a global level. But when you come to the Indian level, HDFC and SBI are the important fund companies in this India. And these mutual funds provide a gateway for individuals to participate in the financial markets while enjoying the benefits of professional management and diversification. So mutual funds provide a gateway for individuals to participate in the financial market. So mutual funds almost, it is one of the gateway only for the individuals to participate in the financial markets while enjoying the benefits of professional management and diversification. So if you're going to visiting the HDFC mutual funds or SBI mutual funds in India, they may guide you in a professional way. They are going to engaging in a professional way. So the professional management must be important to the individuals, because unnecessarily that investor is going to investing money in different platforms or portfolios. So if they are going to investing money with in a not authenticated or not profitable angle, so these mutual funds will help to the investors, not only in India, in a global level also. Vanguard Group and BlackRock iShares also, and Fidelity Investments also one of the, they are the famous and premier companies, because they are guiding in a right way. They are going to controlling, monitoring, and showing the right good returns, and also managing the or mitigating the low risks carrying of the companies. So with that, I'm going to concluding this today's session, and tomorrow we will come with the other this concept, that is credit ratings. So how to give a credit rating, how the what is the credit rating meaning, how companies are going to giving the credit ratings. So here, as of now, we completed the merchant services, mutual funds. Now tomorrow we are going to discussing about the credit rating and venture capital and private equity. These are the concepts that we are going to discussing in the tomorrow's class. That I'm winding up, and we will meet in the tomorrow's class. Thank you.